And welcome back to Corporate Secretary. Today we are going to talk about funding of mergers and takeovers. Moreover, this topic, I guess, it's more of a general topic where I'll be discussing for various type of financial instruments and a quick go through. Moreover, as you will get to know a better exposure with respect to the financial instrument, which can actually be used for the company to raise funds. Ideally, I would like you to confirm here. Before I start with my video now, there's a group of on Telegram, which I would like my viewers to join, and please share with the maximum community you can. The group can hold up to 10,000 members, where we can have a really huge kind of population for the student as well as for the professional, who can share, who can discuss, who can provide more and more information, and will be more helpful for the people who don't have the adequate resources, just because now internet and mobile phones are very in common in use. So this is one of a noble cause. I've started delivering what I have learned so far, and that's all I would like to say. The videos which are being uploaded now is only for the revisionary purposes. I confirm again, there is no detail or deliberate discussions on it, but it will be uploaded for executive, professional, and foundation program. Please join more and more, share with the people, and all the best for the examinations who are appearing for December 2018. So, starting with the funding of merger and takeovers, this is for a professional, if I specify, corporate restructuring, valuation, insolvency. Um, Financial alternatives. It should suit the acquirer, or the acquiring companies should provide desirable gearing level which may suit to the financial structure of the acquirer. The package should be found acceptable by the vendors, and the package should also prove economical to the acquirer. So in this video, I would like you to put a little bit of view on this. So if I am I'm merging, or I'm looking forward for a takeover in a company, first thing is that where should I get my funds from? So there are various instruments where you can raise the funds. Ideally, the company is raising capital by one or the other way. More of us are aware of equity shares, preference shares, which is generally in discussion, but there are many more to come. So let's just go through first through funding through equity shares. What are the features, facts, pros and cons? So it is the permanent capital of the company. The benefit: no fixed amount of return in form of interest. So you can pay the dividend or let it be. Time consuming and costly exercise. Yes, it is a concern. The cannot think of raising money through public issue without identifying the company to be acquired and served a legal compliance. So there's a lot more of clerical work, legal provision have to work into it. So quite a lengthy procedure, but has a benefit. Preferential allotment. It can be organized in much easier way. 62 subsection 1 clause C, where it is for the further public offer. You can go ahead. The video is on the channel. You can look into it, and there's a very beautiful chart which has been created. So as to be compliance with the regulation rule 13 of the company's share capital debenture rule 2014, listed company can comply with chapter 7 of SEBI ICDR 2009. Preferential allotment of equity share, allotment to private placement. Section 42 rule 14 of the company share capital and debenture rule 2014 can also raise fund by QIP, qualified institutional placement, under chapter 8 of SEBI ICDR 2009, only to the QIBs. Talking about the preference shares, can be issued as a purchase consideration. Fixed preference dividend at a fixed interest rate, or fixed amount of return has to be delivered. Acquire need not to make sure that the target company would be able to yield such profit. The burden of fixed dividend as per the agreed terms and conditions. So as according to the terms and condition, you issue the preference shares, the preference shall be given according to such base. Options or security with differential rights. Companies are allowed to issue derivatives, options, quasi equity with differential voting rights. Differential rights can be with respect to the votes or with respect to the dividend. So it can be either of the ways, which makes it more attractive than the rest of the equity shares or any of the security for that matter. Now, provides the additional source of fund without the interest cost and without obligation to repay. In case of non-voting share, there is no cost of control. So, if I give you the dividend differential right for the voting, now if I have to pass a resolution or I have to look forward for anything further, where I am being the promoter or being the board of director of the company, where I need the resolution to be pass by a special resolution, and you have the differential voting right, and you're owning more than 25 or 30 or 35% of the rights. So my company decision will rely definitely upon you, because you being the member, a shareholder is also a owner of the company, giving the equal rights. So it has to be taken into concern before issuing such securities. Talking about the swaps or stock to stock mergers. Now, holders of the target company will get shares of the acquiring company. Very easy. The arbitrage will short the acquiring company stock and will purchase in a long position using the same ratio that of the proposed transaction. Finally, short will be covered and collect the spread which will be taken. So basically, in short, there will be a spread, so within the price 1 and price 2. A position will be created in long run where the price we deem, when I talk about long, we are expecting the price will go up, and when I talk about short, the price will go down. So people will arbitrager will try to eat up the profit between the P1 and the P2, will make the benefit. The stock swap mergers may involve event risk and fluctuation of stock price. Assess the deal involves exchange of shares of the share price in one or more or both. Talking about the depository receipt, yes, very interesting. These are the foreign currency denominated instrument traded in Europe or USA. Popular ADR, GDR, that's what we have. Major benefit to the investor for the collection of issue proceed. A foreign currency which may be utilized for meeting the foreign exchange components or the project cost, repayment of foreign currency loans. So investor need not to bear the exchange risk. So best part is everything is being processed overseas, so there won't be an exchange risks concern. Conversion of the debt to equity share of the company obligation, raising the fund market related prices, minimum cost as compared to the domestic issue, permits raising of further equity on a future date. So the by the end of the day, they get converted into equity shares, so turn out to be the owner of the company. Talking about the financial institution and bank loans, that's what we are aware of. The all the financial managerial information must be placed before the bank's financial institution for the purpose of getting the necessary details for making them to understand that should the loan be sanctioned or not. Period of fund is definite, so you have to take the time for taking such loans has to be specific, that if you have to repay in 5 years, does not matter you make profit or you're not able to pay or repay, has to be an obligation on the company, so it's more or less of a burden. The board is assured about the continued availability of such fund for predetermined period. Interest burden on such loan. It is not easy to obtain loan for the takeover because they are not forthcoming financial securities business. There are two type of expect by bank. First is cost acquiring. If the going concern share of the price would be purchased, there might be a huge requirement for funding of operation, modernization, upgradation, recovery of such cost shall also be considered. So first of all, the cost of acquiring after acquisition, what you have to look into is that yes, after acquisition, if you have to make any sort of enhancement, upgradation with respect to the working, then if there will be any additional cost, the bank will look into the project. Continuing to the two, funding by rehabilitation of finance. Sick industry with healthy units. We have looked into the reverse merger. Merger or takeover may be provided for the post of insolvency resolution plan under the Insolvency Bankruptcy Code 2016. One of the reference made to NCLT will make during appoint an insolvency professional and provide a moratorium. So in this situation, you cannot transfer the assets meanwhile the application is being filed. Talking about the insolvency bankruptcy code, it will also be uploaded soon, so please stay tuned to the channel. And I promise you, people who have studied before, it will be easy for them to revise because the videos are very short and crisp, so you'd be able to revise for the chapters which you are trying to avoid or which you have not all that good grip on. So just go through the video. I know there's not much of a discussion, but yeah, a quick go through is not at all bad. Looking forward to. So there is no provision in the code guiding as to what such insolvency resolution plan may contain, and insolvency resolution plan is created by the insolvency resolution applicant and submit to the insolvency professional who seek the consent of the committee of the creditor. So once it is given to the insolvency plan, committee of creditor is created where they discuss that how exactly the process for the insolvency will go on. Same is put in the front of the approval for NCLT. Funding via leverage buyouts. Leverage buyout is acquisition of one or more company or division of another company, financed with a substantial position of the borrowed funds. Acquire, restore a combination of small investment and a large loan to fund the acquisition. The loan capital is availed through the combination of repayable bank facilities or to publicly or privately placed bonds classified as high yield debt. The debt will appear in acquiring company's balance sheet, and the acquired company free flow will be used for the repayment of the debt to buy out the target company. So in short, if I just give you a short example, let's say this is my company and this is the company B. So A and B. What I'll do is I'll ask my bank to fund for the purpose of the buyout. Now what will happen on the balance sheet of the company B? There will be a loan. Once the company will be merged, the company will have a loan for the company you have bought out. The assets of company B will be put as a mortgage with the bank for the purpose of repayment as a security, and any sort of cash flow remaining with the company B will be used for the payment of repayment of loan to the bank. So by the end of the day, all the effort is to gain the loans from the bank. Now, the target company asset are used collaterals for availing the loans. When the debt is redeemed, the acquiring company has the option to merge with the special purpose vehicle. The debt will be paid off by the SPV using the cash flow of the target company. The acquirer of the large company to make large acquisition without having the commit a lot of capital. So this is how it works. Moving on further, we have external commercial borrowing. This will be the last thing I would be discussing on the video. So there are two routes, automatic and a non-automatic route. Automatic route, you do not to have the approval, and non-automatic route approval is required. So in the automatic route, we have corporates where we have power sector, finance, telecom, railway, infrastructure. Small medium enterprise, real estate, industrial sector, NGOs giving microfinance to others. So there are certain restrictions for the utilization of external commercial borrowing. So the permitted activities and prohibited activities. Permitted activities are investment in joint venture or wholly owned subsidiary is in abroad. Capital expenditure is in projects. Acquisition of the shares of a public sector undertaking from government of India is first level disinvestment. Prohibited activity, general working capital expenditure not allowed. You cannot really lend the amount. Repayment of existing rupee loan, no. Investment in stock market, definitely not a concern. It shall not be taken care of. Takeover of any company in India, not allowed. Acquisition of real estate, not allowed if the company is not in a real estate business. If it is, then it is allowed, otherwise strictly prohibited. Talking about the non-automatic route, those bank or public financial institution which have already participated in restructuring of textile or steel sector. So textile or steel sector, for them not allowed, and the permitted activity will be same as it is, but an additional bank and PFI can lend to the companies. Those NBFC which are willing to import infrastructure equipment. Housing finance company willing to raise minimum 100 million. Those financial institution in India which provide finance for the export activity or take any infrastructure activity. multi-state cooperative society, all other outstanding automatic route, all other route which is you can consider. Now talking about the prohibited activity will same as of the first one has been already discussed. So this was the funding of merger and takeovers. Moreover, also help for the purpose of raising of capital for any sort of venture. Thank you so much. Stay tuned. You have much more videos to come. Please share as much as you can.